Hello, everybody. This is Dr. Gregory, and we are going on to Chapter 12, Part 1, and this is going to be the audits of long-lived assets. Now, just from refreshing, assets, long-lived assets are anything that is greater than 1 year and used as part of the business operations. And we have tangible and intangible. Tangible assets, you can touch. Intangible assets, you can't touch. But you can have some type of support, some document, a patent, a license, a franchise that shows that you have an intangible asset. Just a reminder, we depreciate tangible fixed assets, we amortize intangible assets, and we deplete natural resources. So when we're thinking about these types of long-lived assets, there are, again, a number of accounts that can become affected by it. The individual asset account, the depreciation, amortization, depreciation expenses, as well as their associated accumulated depreciation accounts, gains and losses on disposal, impairment loss. There may be some liability accounts out there if you have to put back the natural resource to its previous state. For example, if you harvest woods, you may have charges or expenses associated to replanting. When we're thinking about the 5 management assertions, we want to make sure that the asset exists, it's in the balance sheet, and the income statement is appropriate. All the transactions that have affected that asset have been recorded within the correct period. The business owns or has ownership rights. For example, in natural resources, they may have ownership rights to the timber, but they may not have rights to the land. So there may be some bifurcated rights. We also want to know that the balances in the accounts have been correctly valued and that costs have been correctly allocated to those contra asset accounts. And we want to make sure that long-lived assets are presented as non-current assets in the financial statements. Now, some companies present the assets, for example, property, plant, and equipment, and then the contra asset of allocation underneath in the presentation, or some companies will just state property, plant, and equipment net of appropriate depreciation. But what you normally will see then is a note in the disclosures that probably has a little schedule about how they calculated the depreciation, the amortization, and or the depletion schedules. Again, inherent risks, fraud risks, and control risks that we have to be cognizant of when we are looking at the company. Under inherent risk, there may be a motivation for management to manipulate losses, which in turn reduce net earnings. There might be incomplete records of disposals and scrap that don't represent the actual events. When we think about natural resources, these are going to have a special challenge all to their own because it's difficult to value whatever the buyer is willing to pay. We don't know what restoration costs are going to be and when they're going to take place. So that's a little bit difficult to look at. We might be able to do some approximation with estimates as far as acres and how many trees per acre and how many acres would be harvested during a fiscal period, which might give you some indication of a rationale to an estimation. And we don't know what the actual costs are when discovering the resource. There may be costs, for example, in mining or mineral extraction or coal extraction, where they have to do a lot of soil testing to determine what value of a resource they may or may not have there. So we don't know going in how much testing or how many costs are going to be associated with that. Regarding intangible assets, the standard states that when you have R&D expenses, those costs are expensed until that thing becomes a viable product. And we don't know when that's going to occur. So it could be a short time period, it could be a long time period. They may come in with the expectation that, for example, a drug is going to be able to pass FDA, and it doesn't. So what do we do with those costs? Costs of patents are to be amortized over the lesser of legal or useful life. And this can be tricky because, again, an estimate of what the useful life is. Most of the time, what companies will do is amortize over the legal life, which could be 20 years or something close to 20 years. And then as it gets closer, they may want to reassess and determine, well, do we still have a useful life of that patent? And if so, then we would revalue and create a new amortization schedule for it. Again, in intangible assets, it's very hard to determine impairment. When does the value of something you can't touch come into play? And what do we do with it? Fraud risks. Some of the fraud risks are incorrect adjustments or miscalculations to depreciation, amortization, and depletion schedules. There could be intentional miscalculations. There could be omissions of years, which can cause the misstatements to be in error. There could be a misstatement of assets due to capitalization of transactions that should be expensed. Remember, repair and maintenance is just that, repair and maintenance. As long as it doesn't improve the useful life or production of an asset, it has to be expensed. But you have to watch to make sure those costs aren't absorbed into the capitalization of the expense. Remember, reduction of expenses, better profits. Now, also is the misstatement of the true value of the asset. It could be that the estimation of the asset is so far off that there is no way that that asset could be valued at something such as that. Finally, under control risks, looking at the entity itself, we also have to look at the audit firm. The control risk may be that the auditor doesn't fully understand long-lived and complex assets, including R&D. So you need to, again, understand the industry and understand the company when you go into it. They may not have access to those long-lived assets. Remember, if you can't see, you can't test. Management may not understand how they need to record the transactions and valuations surrounding long-lived assets. And finally, the entity may have lack or inadequate policies and processes on long-lived asset acquisitions, allocations, impairments, disposals, scrap, whatever. Now, when we're looking at internal controls, we're thinking about the internal control assertions that we have. A lot of it surrounds authorization. Did the person or persons within the company have the authorization to purchase those long-lived assets. You have to go back to the policies and or board minutes of meetings to look to see if the board, who has the overriding authority of all things within that company, has given them the authorization, and make sure that that authorization for what was actually purchased. You want to ensure that assets are properly classified, allocations have been supported by rationale, and valuation of any costs associated. You want to monitor assets for possible impairment. So when we talk about monitoring books and records as one of our internal controls, we want to make sure that we're also monitoring those assets. Are they secured? Are there access restrictions to those assets? When we're thinking about natural resources, we may have to be looking at internal controls as to the authorization and recording of the asset reserves. And you may need the assistance of a specialist. And intangible assets, again, we want to make sure that we have segregations of duties within the organization that affects all three of these types of assets. Those who oversee the asset should not be the ones that are calculating and recording the allocation values. You want to monitor these assets always for possible impairment. You can perform ratio analysis on long-lived assets. You want to look at gains and losses of sales on the equipment. Did the sale occur before the full life of the asset was completed? If so, why? Why would they prematurely sell an asset? It could be for a good reason. Perhaps they have decided that they have stopped a certain line of business segment, and that asset is no longer needed because it was associated to that business segment. You want to do some benchmarking of useful lives against industry standards to see if your useful lives are matching up. You may have multiple assets with multiple useful lives, so it's always good to keep a nice schedule and file on all this, so that when you come in and audit it, you have the records ready to be presented to test. You may want to compare depreciation expense over prior to current years to determine if there's changes. You may perform some actual ratios, such as depreciation expense to total depreciable assets. Are the changes, is this ratio reasonable? And take a look at R&M expenses to total depreciable assets. Some things we want to consider when we're thinking about the evidence that we're going to use to support the operating effectiveness is first talking about those policies, processes, procedures that management should be putting forth to guide the staff on how to manage these more complex assets. We want to ensure then that the costs associated to assets are properly recorded. They're either going to be expenses or they're going to be capitalized to the asset. We want to ensure proper authorization to purchase, sell, scrap assets. So we may need to review the board of director minutes. We want to select certain assets to ensure that they exist. So you're going to go out and test some assets. And you're going to review disclosures and presentations in the financial statement to make sure that all of the assets are included and that any significant information is presented, i.e., gains and losses, asset impairment, maybe situations that occurred that would cause the assets to change. For example, if there was a natural event, such as a hurricane or tornado that wiped out a factory, you'll want to be sure you disclose all that information. Now, some suggested testing for long-lived fixed assets. To recap, inspect those assets. Review documentation regarding them. Observe natural resource assets if possible, or documentation that supports them. Vouch and trace asset to the general ledger back to the asset. Review your capitalization policies regarding when you capitalize and when you expense certain costs associated to that asset. You want to review contracts, title documents, insurance policies, tax records. If there's no insurance expense for a certain asset, it may be that that asset really doesn't exist. So compare your insurance policy and what's being covered under the policy with the schedule of assets. You want to review the policies on depreciation, amortization, and depletion. Then you want to probably calculate and test the allocation schedules. Review carrying values to look at possible impairments. And then finally, review presentation notes and disclosures for completeness and that they are following appropriate standards. Now, we've got some new standards that have come down the pipeline in the last several years that you may want to brush up on, and I've posted those in these videos as well as in your readings. Now, when we're talking about testing for natural resources, it's similar to fixed assets regarding, what management says. Then you want to review those costs of the assets along with the rationale to estimate the reserves and changes on any reserves. And here I would highly suggest that you probably include a specialist to help you out. For example, if you've got land, you might want a geologist in there to take a look at these look at the documentation to see if it's appropriate. You might have to look at any costs associated with that asset, such as if you've got a logging operation, look at the fixed assets associated with the logging operation. Make sure that if we have logging equipment, it's there. So you want not only the fixed assets to the actual asset itself, but any other supportive assets. You might have drilling or exploration costs as part as the cost of mining and fossil fuels. You'll want to recalculate allocation costs and compare them to the reports of the extracted or harvested resources. You want to make sure that your depletion costs for natural resources are in line with the extraction and harvesting of those natural resources. Let's go back for an example. Say, for example, the depreciation expense is based on a harvest of so many acres every year. Then what you want to do is you want to take that, and you see that the schedule says we're going to deplete this based on 120 acres per year. Okay, now go to the harvesting side. How much did they harvest? Because you can't deplete what hasn't been harvested yet. And you have to deplete what was harvested. We're not talking about the sales, just the harvesting. For intangible assets, again, similar to fixed, but you want to take a look at contracts, franchise agreements, copyrights, patent licenses for the existence of the intangible, and then you go back and look at the useful life estimates. Again, we want to test that amortization against the stated values for consistencies, review the documentation of those assets. If there were any disposals or impairments, to make sure that the rationale behind that was correct. Perhaps we sold a patent to somebody else. Therefore, we would have to show that we disposed of that patent and not kept it on our books. We want to review policies on the internal assets and inquire with management on any deviations from those policies. And then finally, review the notes and disclosures. Let's move on to asset impairment. This is a relatively new standard ASU 2017-04, which updates the standards on the documentation of the impairments of tangible assets and goodwill. So goodwill may be a big factor in what you're doing. So you want to review that standard. Now, the book may not have that information in there because the book was written prior to some standards coming out. So if a new standard is coming into effect, I'm going to alert you on it. Now, assets can become impaired for a number of reasons. The asset becomes obsolete. You have a new iPhone that's being sold. You have assets out there that are no longer of the same value. So they lost their value to the older versions. We could have damage, partial or full of an asset. We could have idle assets due to perhaps loss of segment operations. There could be legal and environmental changes that lead us to no longer be able to use an asset in the way we intended it. And finally, there might be costs to maintain the asset that exceed the carrying value of the asset. So perhaps we've got a piece of machinery out there that's costing us more to keep operating than the carrying value is. So we consider that asset to be basically underwater. Let's switch over to leases. Leases are merely the exchange of something, money or other assets, for the use of an asset that they do not have ownership rights of. Now, here's a new one. Topic 842. I would suggest that you take a look at that. Understand topic 842 on leases. There's some changes that have been implemented in leases that you will need to be aware of going forward. You won't need to know this information now, but start to get a feel for it. The FASB and the AICPA both have some literature on this, but look for topic 842. I'm seeing a lot as a CPA. I'm getting emails at least once a week on lease 842 standards and what those standards mean and the complexity behind accounting for leases. So the text is going to be covering ASC 840, which is the old lease standard. So if you don't know that one, you'll have to look at ASC 840. The new lease standard is ASC 842. When we look at substantive tests regarding leases, we want to make sure that the client gives us a schedule of leases that we're going to test. And we're going to go back and pull the documents. We're going to make sure that it's an operating lease and not a capital lease. Remember, there's criteria for a capital lease. For example, if there's a bargain purchase agreement in that operating lease, it's no longer an operating lease, it's a capital lease. So make sure they're classified correctly. You want to review and ensure that the expense accounts are correct for the lease agreements. Again, there will probably be a schedule that you'll get from the client that you will test. Review for the existence, look at the contracts for the rights and obligations and valuation, and then review and update knowledge on changes to lease standards 842. Now, looking at some fraud-related considerations. Well, one of the things we have that could be fraudulent is the assets aren't there. Or there have been assets that are impaired that are still on the books at an unimpaired value. So look at the condition of the asset. Is it pretty beat up? Sometimes when they come in and maintain a piece of equipment, there will be a sheet of paper on the side of that equipment that shows the maintenance schedule and everything that's been done. Might want to look at that. Review the list of long-lived assets. and randomly test. You're looking to see, are they there or are they phantom? They may have assets on the books that they've sold. And it might be an error and it might be an irregularity. You want to review any appraisal and title documents to make sure that the client has the right to use. Review any allocation schedules and randomly recalculate them. Risk of manipulation of the expenses in the financial statement. So in summary, we looked at examples of long-lived assets. We looked at suggested substantive tests for fixed assets and for natural resources and intangible assets. We took a quick look at asset impairment. We looked at leases and suggested substantive tests, and we looked at some fraud-related considerations. If you have any questions on this, please reach out. I hope you have a really terrific week, and I'll see you in the classroom.